Welcome back to the Financial Literacy Project, presented jointly by the American Bar Association's Tort Trial and Insurance Practice section, along with Thomson Reuters. I'm attorney Purad Razavi, and this is the third segment of the Buying a Car module. In the prior segment, we discussed the purchasing process. In this segment, we'll cover how to finance your purchase. Please read our legal disclaimer in full. To summarize, these materials and any forms or resources we reference are intended for educational and informational purposes only. Let's talk about financing. Now, once you've decided how much you can afford for a car, you'll need to decide how to pay for it. Paying cash or trading in another car are the simplest approaches. Now, many people, though, have trouble paying for a car in cash. Also, if this is your first car, you won't have another trade. Now, the other choice is to borrow the money. Before you apply for a loan, however, there are some steps you should take. So let's talk about how to prepare yourself for financing a car. First, check your credit and improve it if you can. Credit scores are one of the biggest factors that lenders consider when deciding whether to approve a person for a car loan. Now, we talked all about credit scores in our segment on Banking Matters, Understanding Credit, and the link to that segment is in the materials. But just to summarize, a credit score is considered fair or poor if it falls below 670 on the FICO score, which ranges from 300 to 850. You are entitled to a free credit report every 12 months from each of the three major consumer reporting companies, Equifax, Experian, and TransUnion. The link and a phone number to request a report are in the materials. Now, improving your scores may help you get better terms and a lower interest rate, and here are tips for improving your credit. 1. Pay all your bills on time. Payment history is one of the most important aspects of your credit. 2. Reduce your debt as much as possible. And 3. Limit your applications for loans or credit cards. Let's talk about preparing your down payment. When you buy a car, you'll typically provide a down payment. Now, the down payment can be in the form of cash or a trade-in. This down payment will go directly toward the purchase, and the remaining amount will be paid over time. So the more you put down, the lower your loan amount and monthly payment will be. Additionally, a larger payment reduces risk to your lender, which may help you secure even a lower interest rate. Now, coming up with the down payment isn't always easy. You may need to consider delaying your car purchase to save for one. Doing this could make you a more competitive applicant, lower the amount you own, and help you lock in a lower interest rate. Let's talk about getting pre-approved for a loan. Pre-approval is when a lender checks your credit and finances and tells you how much of a loan they may be willing to give you. It's not a guarantee of a loan. It's only based on the information you have supplied in your credit report. You will not get a firm approval until you have actually formally applied for the loan and the lender has confirmed all of your information. Now, once you've been pre-approved, you should have a better idea of which vehicles are in your price range. You may be able to use your pre-approval to even negotiate a better purchase price with the dealer. If you're having trouble getting pre-approved from a loan from a conventional lender, you may want to look at lenders that are known for working with people that have lower credit scores, sometimes known as second chance lenders. Be aware, though, that loans at these second chance lenders come with higher interest rates. They should not be your first route. Before committing to any of these higher interest loans, you should consider other resources. Now let's talk about shopping around for the best loan. Whether you have pre-approval or not, you should still do some shopping around for loans before you go to the dealer. And there are several different options for obtaining a car loan. Here are some examples. 1. Financing through car dealerships. Often you'll see ads from those auto dealerships saying that they can get anyone a car loan. You should be aware that most car dealers don't lend money themselves, except for the buy here, pay here dealers, which we'll discuss separately. Most dealers simply act as agents for third-party lenders such as banks, credit unions, and finance companies. They are compensated by the lenders for placing the loan. So you may get a loan that suits your needs, but you might also end up with a loan that gives the dealer the best return rather than giving you the best return. So before you go to a dealership, you should check for rates with other sources, again, like banks and credit unions. This is not to say you shouldn't consider a loan arranged by the dealer, because some dealers, and actually many dealers, have relationships with legitimate lenders, and you may end up with a better interest rate than you could on your own. However, you won't know if you haven't done your homework first. Large national banks. Large national banks are the ones many of us know by name. They have thousands of physical branches around the country, smartphone apps, and online portals. Their lending operations are sophisticated and they offer comprehensive online lending resources, but they may not be the best choice if you need personalized service or extra handholding through the loan process. Community banks. Community banks tend to have anywhere from one physical branch to a few dozen spread across smaller geographic regions and areas. They may not have all the branches and services of national banks, but you may find it easier to talk with a local representative if you need help in getting a loan. Online-only banks. Online-only banks have no physical branches, though many offer the same services as the large national banks do. Ally, Discover Bank, Capital One, and Synchrony are just a few examples of online-only banks. Credit unions. Credit unions differ from other lenders. They are cooperatives owned by their members. Instead of providing profits to shareholders, nonprofit credit unions return their excess revenue to members in the form of lower interest rates on loans and higher rates on savings accounts. They range in size from tiny one-person operations to massive institutions that rival the size of some national banks. Credit unions account for about 30% of all car loans in the country. Now, not every credit union is open to every consumer. For example, only people with certain jobs can join some credit unions. Others are open to anyone. You'll need to check with a particular credit union to see what its terms of membership are. No matter which credit union you choose, you will need to become a member. This will require you to open an account. The amount needed is generally low, typically from $25 to $100, although some credit unions may require as little as $5 to open an account. Captive finance companies. Most automakers have financing arms known as captive finance companies. Examples of these are Honda Finance, Ford Motor Credit Company, and Stellantis Financial, formerly known as Chrysler Capital. In addition to traditional car loans, these captive financing companies sometimes offer special financing deals, such as zero or low interest loans. Now, be aware that loans from captive finance companies may apply only to new cars or certified pre-owned or CPO cars. In addition, the best rates are only available to highly qualified individuals. In other words, those with excellent credit. Now, let's talk about tote the note or the buy here, pay here dealers. Tote the note is another phrase for a buy here, pay here dealership or BHPH dealer. When you buy a car from a tote the note dealer, you finance and pay for the car with the dealer directly rather than going to a third party like a bank or credit union. And the dealer will tell you that there are benefits to this arrangement. For example, the opportunity to get a car with no credit or bad credit. Tote the note dealers do not run credit reports, they just depend on income verification. And it may be easier to get a car. As the dealer itself is financing the car itself, the process may be quicker. There are, however, significant risks with tote the note dealers. For example, high interest rates. You may pay 4 to 5 times the interest rate of a traditional car loan. There may be compressed payment schedules. Many loans from tote the note dealers are due weekly or every other week. Many borrowers are unfortunately unable to keep up with the payments due to the higher interest rates and the more frequent payments. There's also often limited car choice. The dealer will look at your income first and then propose a car you can afford. This usually results in a limited selection of older vehicles. There may also be higher down payments. In order to reduce its risk and to make the payments seem like something you can afford, a tote the note dealer may require a higher down payment than a traditional dealer. Often the down payment is close to the full value of the car on the open market. There's also a higher risk of repossession. Any lender may repossess your vehicle if you don't make your payments. Tote the note dealers, however, may allow you less leeway than a traditional lender. Many tote the note dealers will install a tracking device in your car to make it easier to find and repossess. Many tote the note dealers will end up repossessing the car just to recycle it to another borrower. Now, many commentators will tell you that a tote the note dealer should be a last resort, so you should consider every alternative before buying from a tote the note dealer. Now, what if you need a car quickly and your credit still needs work? If you need a car quickly and don't have time to improve your credit, here are some suggestions. 1. Get a cosigner. A cosigner is a person that agrees to apply for a loan with you and is equally responsible for making loan payments. Cosigners typically have proven credit and give the lender added security. 2. Increase your down payment. The bigger your down payment, the more likely it is you'll get approved for a car loan. A larger down payment not only reduces the amount you need to borrow, but also shows lenders you're serious about paying off your car. 3. Choose a cheaper car. If you can't get approved for a loan, finding a less expensive car will reduce the amount you need to borrow. Even if your credit isn't good enough to land you a large auto loan, a lender may approve your application for a smaller one. 4. Look into second chance car loans. We mentioned these when we talked about pre-approval. These types of loans are meant to give people with bad credit a second chance to reestablish their credit. You may find second chance auto loans at some credit unions, banks, and even online national sellers. Lenders that offer second chance car loans may have added requirements. For example, you may need to keep a checking account with the institution and have your payments deducted directly from that account. These loans also carry higher interest rates than conventional loans, so you still need to consider your options carefully. That concludes this segment. We hope you now have a general understanding of how to finance a motor vehicle. In the next segments, we'll cover what to consider when deciding between buying new versus used vehicles. Thank you.